Hello students, today I just want to provide you with a little overview on the income statement. Hopefully this will help you to better understand the income statement and its components. The income statement is one of a company's core financial statements. It shows their profit and loss over a period of time. The profit or loss is determined by taking all revenues and subtracting all expenses from operating and non-operating activities. The income statement is one of three statements used in both corporate finance and accounting. The statement displays the company's revenue, costs, gross profit, selling and administrative expenses, and other expenses and income, taxes paid, net profit in a coherent and logical order. The statement is divided into time periods that logically follow the company's operations. The most common periodic division is monthly for internal reporting, although certain companies may use a 13-period cycle. These periodic statements will be aggregated into total values for quarterly and full-year results. Just as the balance sheet had an equation, the income statement follows this equation. Revenue, or sometimes called income or sales, minus expenses equals profit or loss. Now I want to take a look at Exhibit 3.1 in your Fritzen-Alvarez book. This is an income statement for Peet's Coffee and Tea for the period ending December 2009, 12 months. So this is an annual income statement. And you'll see the very top line is total revenue. Sales revenue is the company's revenue from sales or services and is displayed at the very top of the statement. Some companies have multiple revenue streams that add to a total revenue line, and that's what we see here with Peet's. Because everything starts with sales revenue, you often hear this first line referred to as top line. What's the top line doing? In this case, it's total revenue. Next, we see cost of goods sold. Cost of goods sold is a line item that aggregates the direct costs associated with selling products to generate revenue. This line item can also be called cost of sales if it's a service business. Direct costs can include labor, parts, materials, and allocation of other expenses such as depreciation. Gross profit is calculated by taking total revenue and subtracting the cost of sales. Selling, general, and administrative expenses, also known as SG&A, include the selling, general, and administrative section and contain other indirect costs associated with running the business. These include salaries of management, rent, office expenses, insurance, and travel expenses. Not all companies will have this next line item, pre-opening costs. Apparently Peet's wanted to keep track of any startup costs for new entities that they establish, but you'll see they have nothing in that dollar amount there. Depreciation and amortization are non-cash expenses that are created by accountants to spread out the cost of capital assets such as buildings, equipment, vehicles over their useful life. And while we're on this topic, let's think about depreciation here. Let's say that a company bought a new piece of equipment that cost $25,000. If they expense that whole $25,000 in the year that they acquired it, and let's say that machine has a 5-year useful life, they wouldn't accurately be allocating the expense. So what depreciation does is it allocates that lump sum expense over the useful life of that particular piece of equipment or machinery. Amortization expense is like depreciation, only depreciation is recognized on tangible assets that you can touch. Amortization is used to recognize the expense of intangible things like patents or intellectual property. And we see other operating expenses. They had none. When we subtract the total from gross profit, we get operating income. Operating income represents what's earned from regular business operations. It's often known or referred to as EBIT, which stands for earnings before interest and taxes. If the company has debt, they would also recognize interest expense. And also, if they have any interest that they've earned from investments, they would show that as a separate line item and then net the two out here. If they own any other companies, they could have income or losses from affiliates. If they have sales or expenses in foreign countries, they might incur gains or losses from currency exchange fluctuations, and then any other non-operating income. So we would have earnings before taxes and any unusual items. And we go further, and it looks like Pete's had some restructuring charges. That's known as an unusual item. It's not going to happen every year, and they've recognized that here. If they had any gains or losses on sale of investments, if they had any asset write-downs, maybe the value of an asset has undergone some decrease, they would recognize that here, and then any other unusual items. So we get to earnings before taxes, including unusual items. Then we recognize the income tax expense, any minority interest in earnings, and earnings from discontinued operations or extraordinary items, and we get to the bottom line, which is net income. So top line is total revenue, bottom line is net income. I want to take a look now at Exhibit 3.2, and this is a comparison of Starbucks, Panera Bread, and Pete's using common size financial statements. So what common size means is we take the raw numbers and we convert them to percentages. So let's look at Starbucks here. Total revenue represents 100%. If we take cost of goods sold and divide it by total revenue, we see that their cost of goods sold was 43.25% of total revenue. Gross profit, the difference between total revenue less cost of goods sold, is gross profit, and so if we take that number and divide by 9882.1, we would come up with a gross profit margin of 56.75%. Now these percentages by themselves are kind of meaningless, but when they come into value is if we compare between companies or if we compare trends of the same company over periods of time. So for instance here, we could, just from our preliminary analysis, we can see that Starbucks has the largest gross profit margin of any of these three companies at 56.75 compared to Panera Bread's 39.18 and Pete's 20.15%. We can do the same thing with expenses. So here they've combined selling, general, and administrative expenses, and if we take this number and divide by total revenue, we would come to 39.04%. And we can see that Starbucks has a much higher percentage of selling and general administrative expenses, more so than Panera Bread and Pete's Coffee. And that probably has to do with Starbucks' business model, being a destination place with large seating areas and Wi-Fi and many stores in convenient corner locations. That probably all adds to their selling and general administrative expenses. We can do the same thing with other line items. Depreciation, we take that and divide by total revenue. We see 5.37% for Starbucks, and we can do that all the way down. When we go to the second page of the common size income statement, we get to the bottom line and we'll see that Starbucks although they had the largest dollar amount of net income compared to the other two competitors, their percentage of net income was actually the lowest of the three. So in this particular year, even though Starbucks was much larger, had larger gross profit margins, their net income margin was the slimmest of the three. So I hope this brief overview of the income statement and common size income statement was helpful. Please refer to other resources in Moodle as well as your Friedson and Alvarez textbook. Thanks.